Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to the show, everyone. Thanks for being with us. I'm Chris Boyd, a certified financial planner practitioner here with Jeff Perry and Russ Ball, both of whom are with me on the AMR team at Wealth Enhancement Group. And we're going to talk a little bit about markets and pensions today. So to start things off, great headline I saw yesterday across my phone. Markets hit new high, right? And we keep hitting new highs. What was it, Jeff? You said it was both the S&P and the NASDAQ?
That's correct. Yeah.
And I think, on the one hand, that gets people excited, hey, all right, new highs. And then at the other hand, it gets people nervous, like, oh my gosh,
It's been quite a couple of years here.
Yeah, we've had some really good run, just in the neighborhood of up 25% last year and this year. So thus far, the year's not over, but about a month to go. And we'll see where we land when all is said and done. But it does cause you to think about, on the one hand, am I getting enough of that? And then on the other hand,
right, fear of missing out.
Yeah, right. And then on the other hand, should I be worried about the other shoe going to drop? That kind of thing. So you get these different kinds of anxieties that bubble up.
My little favorite saying here: bulls make money, bears make money, and pigs get slaughtered.
Yeah. So where are you in that perspective today? When you think about the market, is someone being a pig if are they staying too long?
Maybe it's a coincidence that you wanted to talk about this today, because I recently saw, I think it was this morning or yesterday afternoon, commentary on CNBC that there has not been a correction, 10% decline in the market this year, which, corrections are normal. You say this all the time, Chris. Corrections are normal parts of the market cycles. Even in a bull market, a 10% pullback is normal.
That inhale, exhale kind of thing, right? It's just
exactly
the normal course of activity. It is surprising we haven't had a full 10% drawdown this year. I was looking at a JP Morgan slide. It showed that there was about an 8% decline thus far this year.
So I'm going to answer your question. I don't want to evade it by referring to CNBC.
Yeah,
I'm a bull. I'm a long-term bull, but I think it's prudent when you have a nice run, staying away from the pig thing, is to take some profits, put them in either a holding area to reinvest, maybe a money market account, or if your risk tolerance is shifted because of gain, if your risk tolerance is what it is and your allocations have shifted because now you have all this much greater exposure to stocks, it might be a time to rebalance and say, okay, I have too much stock for my comfort level. Let me put some off to the side into a different type of investment that's not correlated with the stock market. But I am a long-term bull. I believe in the country. I believe in, free enterprise. I believe in the history of the stock market. So for my long-term money, and for our clients who have long-term horizons, I think the stock market has a place in their investment portfolio for sure. But make sure that your allocation isn't out of whack and that your risk tolerance is able to handle your current allocation.
Really well said, Russ.
Yeah, one thing it's kind of been coming up again and again in client conversations we've been having, and we're just looking at the outperformance of the last year or two, I guess, and asking, are you comfortable with this amount of risk? Like the fact that the market has gone up as much as it has, it could be a good time to rebalance, even if obviously we do our rebalancing quarterly, but I think just having a conversation is risk. Are you too risked in your portfolio?
Yeah, having that open conversation. Are you comfortable with where you're at?
Yeah, and because the market's done so well, it could be a good time to take some of that risk off the table
if a change is pending.
Yeah,
rather than after.
Right.
Chris, you do something with our clients that is that I've learned many things from you, but this one really is key. So when you say to a client, they may have $1 million portfolio, for example, and you say, can you sustain a 10 or maybe even a 20% reduction in the market? Those are normal things that happen in the market, and you might get a quick yes, but then you frame it in the context of that would mean between $100,000 and $200,000, and that their face just changes from 10% when you say
yes. It's a different thing to say $200,000.
Oh, well, wait a minute.
Well, wait a second. That's a lot of money, right?
It is 20%, but
it puts it into a little bit different.
Right.
Yeah, it's exactly true. You got to make the material, and for whatever someone's level of wealth happens to be.
Right. The same principle applies if you have $10,000.
And people who have $10,000 say, well, if I had a lot of money, meaning $1 million in that scenario, right? They'd be like, I could live with that, but I can't afford to lose, 20% in that
Very
scenario,
true.
right?
Very true.
And if you have $1 million, you think, well, 200,000, that's a lot of money. So it really depends on the person, right? On what's going on in the rest of their context and what they're really willing to tolerate. I think it's worth pointing out that historically, we talk about over a very long period of time, 100 years, markets tend to go up 2 out of 3 years, but it doesn't happen that they necessarily go up every 2 years, and then there's a third year. It doesn't, it doesn't always happen sequentially that way. There can be periods of time where we have, think of the year 2000, where we have 3 years back to back with declines. It's hard to tolerate. We've had the good fortune lately when markets go down, they come back very quickly. In 2020, we had a 20% decline or whatever it was during the year, but it didn't end that far down, and it came back very quickly. Within a year, we were back in business, let's say, into the positives. When it came to 2022, very quickly we're back in the positives. So it's tough when you see markets drop, but we've had the good fortune that they've come back very rapidly in recent years, and that's not always the case. Investors should, be prepared for the way they think about their investments, as you described it, Jeff, long-term in nature, and therefore, you might be tolerant of a couple of bad years back to back, whatever it might be, so that it might take. What if it takes 5 years to recover? What if it takes longer? The 1970s, a prolonged period of time. You could even look at the 1990s, where you started at this peak at the end of the 1990s, and then in 2000s, rather, we have this peak. It declines, it comes back in 2007, peaks again, and then declines. We end the decade not really much different from where we started the decade, probably even a little lower. And so there you look at that and say, well, this can happen from time to time. It's not to say that it's always the case or that it's going to necessarily be the case. But when you look at year to year, markets move in different directions every year. Given time, you'd expect better performance. So I'm looking at a slide from JP Morgan going back to 1980 through the end of the month, November 30th, last a couple of days ago. And it's suggesting that the average annualized returns over that period of time was around 14%.
That's good.
Yeah, isn't that awesome?
Very
right?
Good. Yeah.
And yet 33 of the 44 years involved were positive, and 11 were negative. That's still pretty good odds for, better than the 2 out of 3 kind of
It's like 3 out of 4, that one.
it's more like 3 out of 4, right? So,
Mhm.
something to be mindful of, but it is very common, even in years when markets end higher, that they've had a correction or a more substantial decline. We talk about this with clients that it's normal for markets to decline 10, 15, even 20%, in some cases more, right? But, we've been through in the 2000s and,
Sure.
2020, we've seen these more substantial declines. Um, so it's not unheard of for markets to get cut in half in our recent investment lifetime. Not just looking back at like long history of things, just if you've been an investor since 2000, you've incurred 2 periods of time where the markets essentially went from down about 50% cumulatively in the case of 2000, 2001, 2002, and then again in 2020 where the market dropped, no, sorry, 2008,
Right.
right?
Yep.
The financial crisis,
Right.
and then those were significant drops,
The
and
big
then I
ones,
think
yeah.
in 2020 two was down about 34% in a year, and then it came back very quickly. But my point is, these are things that we don't think of as normal, but we've seen it, and as
And we're
much
gonna
as
see it
we're
again.
gonna see it, and so as much as things are really good right now, and I'm glad, and we're not trying to scare anyone to say that they're
No.
necessarily going to be terrible or anything. It's just you have to be mindful of the fact that markets move, and we get more return from taking more risk because there is risk and there will be declines. We just don't know when and how much at a given moment in time. But knowing that, we want to prepare. And we talk about this a lot, Jeff and Russ, when we talk with clients about buckets and
Right.
the idea that we want to have low risk money, a place for security and safety, some comfort type money, and then something that's maybe a little less risk, but somewhere we could get at stuff if we need it. And then we think longer term, more in line with our risk tolerance, whatever that is. Maybe you're a moderate investor. Okay, that whatever that looks like as in aggregate. But we don't want to be too short sighted, and we don't want to be ignoring risk. It's this trying to find this sweet spot for everyone's own circumstances and what's palatable for them.
Right. And think about how long your time horizon is. I'll share a personal story that I've already shared on the radio, so I'll kind of give an update on it. I have a granddaughter who's going to college. She's a senior in high school, and we've had her 529 invested in a S&P fund forever. It's done very well. And on the show before, Chris, we talked about, so what do you're going to leave it invested? And so just last week, because of the market gains, I took the first year, what we expect our contribution to her,
Yeah.
and put it in a money market.
Yeah.
And I left the rest in there for the other years because I feel like we're getting, another word I like to use, frothy. The markets are getting extended, and maybe they'll keep going. And if they do, that's great because 75% of the money is still invested.
Yeah.
But I have that peace of mind that I know that
you're ready for whatever
for the first
direction
year.
things move in the short term.
Right.
You've got it prepared. And and you can't feel bad. Like, what if the markets go higher, Jeff? You'll have missed out on that extra
just for the
percentage
first year.
of returns.
Just for the first year. I didn't like get nervous or make some emotional decision and say it's all coming out and miss the next
right
4 years, if you will, of opportunity. I just made a strategic, I guess,
decision. And I think some of that is also your tolerance and temperament for risk. Someone else might say, well, maybe I don't want to risk it for the next 2 years. You know what I mean?
Right.
Like,
very personal, right?
Yeah, it could be somewhat of a personal evaluation, right? But yeah, I think that's a good example, a good illustration of that notion. And you can't live in the past too. If you make that call, you make that judgment, you're doing something that gives you comfort because of its absolute and then you can't live in the, oh, if only I had, what
No.
if I had done.
No.
It's one of these things where there's no way to know in the short term what's going to move, good or bad. Better off to just say, this gives me peace of mind, whatever direction that is, staying invested or and living with the risk, or pulling the money off and living with the diminished return potentially, that kind of thing, the absolute of having it on hand.
We do hear a lot of clients or people that we engage with saying, well, I'm going to stay invested until I see something that I'm concerned about, or I'm going to stay on the sidelines until something happens.
Yeah.
These corrections or bear markets happen quick when they happen. So I know I can't time the market successfully, and I don't think there's anyone who really can over long term. People get famous for doing it once.
Yeah, right.
But where they go after that, that kind of gets
So
very.
I guess my point for listeners on this topic is, we've had a great year. We've had a great 2 years after some, a rough year, but the prior, 3 years before that, again, really fabulous double-digit returns. So what's my message? Markets are volatile. We've had a good run. It's okay to stay the course or all that, and you should have a plan that works, but expect volatility. And as much as we may benefit from just a consistently rising market, but that's not normal. So expect bumps in the road. And if you don't want to tolerate those bumps in the road, reassess your level of risk and what you're willing to tolerate. And maybe, as you talked about earlier, one of you guys, the idea of rebalancing. This is probably a reasonable time as we look to moving toward year end, start a new year. It's probably a good time to reassess what's the right level of risk. Do I have the right allocation? If you do, rebalance, because you've had this disproportionate return in the last couple of years. If you haven't rebalanced, it's time. And that forces you to do the discipline of selling high and buying low, and that's a good thing over time. You know what I mean? So
it's a good thing.
Yeah. So in any case, something, just food for thought as we, look ahead. I wanted to also talk about a couple other things if we can switch gears. We probably could end the show there and be like, okay, that was one episode, but I got some more to talk about. I had a conversation last night, and Jeff, you came to mind. I thought, oh, this would be a good one to clarify for people. Have clients who are planning for their retirement, and they're in their 50s, but getting closer to, thinking about retirement at either 60 or 65, right? So it's a few years off, but they're getting close.
Great time to have this discussion.
And so, we had the good financial planning, kind of modeling. But when push came to shove, they were like, well, I'd really rather retire at this age and that age. So one for him and one for her. So she has a public pension. So it's the teacher's retirement system.
Yep. In Massachusetts.
Massachusetts, yep. So she had been looking at things saying, well, if I work till age 65, she had calculated the numbers for years of service and the amount of the age she would be at the time.
Three factors, right?
And her income, that's
it.
Third, yeah. So she was kind of looking at it saying, all right, this is what I think my pension number would be. And then we talked about the possibility of retiring sooner. And the question that she's like, oh, well, it'll change my numbers completely. I was like, yes, it would, but you don't necessarily have to turn it on right away.
True.
And that was what created the, oh, well, how would that work? So I just thought maybe you'd want to elaborate on, does the number change if the years of service doesn't change, or is it these two distinct factors?
So like every financial planning question,
it depends.
Yeah. So in Massachusetts, there are three factors. And when you reach the maximum factor of any maximum level of any one factor, it does not go up. So the maximum factor for the number of years of service is 32.
And
So
she does not have that.
Right. So if she works more, say she had 25, for example, right now. If
She's
she
20 right now.
So if she has 20, you need 10, by the way, to even have this discussion. But so she has 20. So for the next 12 years, she'll get an increase in her ultimate pension if she adds a year of service.
Mm-hmm.
The max factor for most public pensions in Massachusetts is 65. So if you're below 65, you to get a small reduction for each year you're below. And then depending on when you started your state service, for her 20 years ago, it's the highest of the average of the highest 3 years of
Mm-hmm.
salary.
Yeah.
And so if you work longer and your pay is going up, like most public employees, they get 2 or 3% raise every year. That factor of the average of the highest 3 would also be going up.
Yeah.
So for someone who's going to have a higher salary, only has 20 years, and is below 65 each year, all 3 of her factors are going to be going up. Now, whether that's enough of a change over the next 12 years or 10 years is kind of a personal decision. Doesn't mean she has to stop working. Also, she could, as you alluded to, she could stop her public service and not take her pension.
Yeah.
Obviously, her years of service wouldn't be gaining, and her highest 3 years wouldn't change. But her age factor would. She could wait till 65.
That's where I was going with it. That
Mm-hmm.
Say she wanted to. That's a good analogy, example or illustration. It was 65, 70, whatever the number is, right? Let's say 65. She delayed, right? And
no reason to delay past 65. No
benefit for this situation,
right?
You're right.
Yep.
So let's say, for example, she says, I want to stop working in 3 years or whatever it is, instead of waiting until 65 or, that kind of a number. Well, okay, then you could stop working. Whatever your years of services would be locked, that number of years of service.
Say 23.
23. And then she doesn't have to turn it on at that age. She could wait. And I think that was where she was like, oh, how does that factor in? That there's a different calculus.
At that point, it's a math question.
Yeah, so it becomes maybe you wait a couple of years, and when you're ready to turn on the income, if you wanted to, if they wanted to start it right away, they could do that. But they'd have their choice. So those aren't necessarily the same decision. When you retire and when you start the pension, aren't the same.
They don't have to be.
And the same is true with Social Security. When you retire and when you turn on Social Security, doesn't have to be the same time.
That's right. For the public pension, there is a secondary level of question: is where are you getting your health insurance? Because if she stops working, she'll lose her employee benefit. If she retires, if she gets to 65,
so retirement is turning on the pension in that case, right?
Right, but she could retire now or in 3 years and still have the health benefit, even though she's not 65. Her health benefit would change from the state when she is 65, but you can't pause your retirement and could get the health benefit, is what I'm saying.
That's a great point. That's a great, that's additional consideration. So in their case, this family's case, if they do it before 65, that might be a relevant consideration to where they want to draw their benefits from. Yeah.
Yep. And the other question that's always in this subject is survivor benefit. In Massachusetts, if you collect your full pension, it's on your life only, the employee's life. If you leave a survivor, typically a spouse, you'd lose roughly a third, round number, of your monthly benefit, but the pension would survive you and go to a second life. In other words, the death of the second life, your spouse. And that's just a personal decision based upon a lot of factors: age, health, other pensions, other assets.
Well, that's the other topic I wanted to bring up when coming into the topic of pensions. I had another scenario where we got an inquiry from a client saying, we have this pension option. It includes the possibility of a lump sum as one possibility.
It's a private pension then.
It is a private pension in this case. They also have, this decision of, well, what should we do when it comes to the monthly income if they opt for that? So they have, this range of possibilities to evaluate. And, I think this is a tough one sometimes because, on the one hand, there's an impulse to say, well, I want that cash. Let's control this whole thing. And then on the other hand, some people say, I want a guarantee. I like the absolute. I don't have to worry about it. I know what I'm in for as long as both of us live, whatever the way they choose it. Right.
Right.
So it becomes sort of a challenge to say, well, how should we think about this? And life expectancy does certainly factor into how you think about this. If you envision a prolonged life expectancy, that really does help make the case to suggest that maybe the absolutes, the guarantees of the pension options might, and maybe some manner of survivor benefit, would have virtue. Another possibility would be to think in terms of, if you don't think there's a long life expectancy involved, well, the idea of a larger lump sum that you might have assets to retain to pass on as wealth, that you aren't worried about the risk of running out of. I think in this case, it also comes down to what are the other assets involved?
Right.
How much do you spend? Where's that money coming from? Right. If there's demand for more resources, then, then the pension might be the right way to go. If you've got maybe more coming in than you need, well, then a lump sum sounds pretty appealing. You can control that a little bit more. I don't know. Anyway, I just thought that was another variable talking about pension discussion.
I think that's a whole episode, that question of a private pension lump sum on your Social Security. All of these factors is probably a whole episode.
Well, a recent conversation we had, Chris, was you were kind of comparing what is the return you can get based on that lump sum per year. And it's like, can we beat that number by having invested? And if not, maybe it's best
there used to be circumstances, 20, 25 years ago, we'd sit down with people who had a pension, and the formula for how they calculated the lump sum had to do with interest rates. And, 25 years ago, interest rates had dropped from being, historically more normal to that zero or very low interest rate environment. And suddenly these lump sums were fabulous. Yeah. And you'd say, well, we could make 4%, whatever, right. Let's just take some risk, that kind of thing. When I was doing this recently, what was it, like more like 8%, that they'd have to be able to consistently earn. Well, if you're going to expect 8%, some of that's coming off of principal in all likelihood over a retirement, right? The level of risk you'd be willing to tolerate, the volatility that you'd expect, there's going to be down years, and some of that comes out of capital, right? So, it's less of an absolute, so that kind of thing. So it becomes a question of, well, let's take a look at what's that rate of return? How long could we expect that to last? Even, with some market disruptions and things like that, the way you'd be invested, that sort of thing. What's the rate of return we might anticipate from something like that? And then again, it's not an absolute, it's a calculated risk, right? So again, all these variables of how's it fit into the whole becomes part of that equation. But yeah, Jeff, it probably should be its own conversation, its own episode, because there's a lot to evaluate. There's the whole idea of, do I take the lump sum? Do I take a pension with a single life and buy some life insurance
Right.
to
That's where I was going. Yeah.
yeah,
And
to replicate that potential for keeping capital in the family kind of thing.
almost every pension question that I've helped people go through, you at least look at if you take the larger pension on the one life and purchase a permanent life insurance policy for their surviving spouse, does that math work? The delta between the
Yeah.
higher pension, lower pension, is that adequate to pay for, in essence, that life insurance policy? Sometimes it is, sometimes it isn't.
So, one of these instances, I had a circumstance with a client who had a diminished life expectancy for himself, but the spouse was the one getting the pension. So, do you get a term policy as a way to do that for, just in case? Do you take the pension option with a period certain?
Right,
Um,
right.
um, so it's a tough one.
And as we know, we've mentioned this before on the show, that people who assume because of family history or recent medical condition
Yeah,
that
exactly.
their life expectancy is short. We have, I'm obviously not going to say the names, but we have numerous examples where that was not correct.
Right. Where people think they're going to have a shorter life because that's been what's happened in their family history. And then they've taken better care of themselves. They don't drink and smoke the way their, maybe their past generations did or something.
Mhm.
And their heart conditions are treated better with new medications or, fill in all the blanks about,
Right.
medical advancements. And or the kind of work life they had that was more demanding physically, all these possibilities, right?
Yep.
So um it's not the same necessarily, so it doesn't always go the way you expect.
And the other issue, just to tease the topic a little bit more for
Yeah.
people, is the consideration of a lump sum and how you view your legacy goals. Right? If it's, if you have no heirs or have no heirs that you intend to or have a desire to substantially take care of, so to speak,
Yeah, it's a good point.
versus if you really, you really want to
That
leave
priority
financial
of
legacy, then,
yeah.
you know, though that kind of mindset about your legacy plays into whether or not you want the lump sum, or
It's a good point.
whether
It's a good
you
point.
don't want the guaranteed income, right?
So I guess the takeaway for those thinking this through is these are difficult decisions. There's a lot of variables to consider. You talked about in another example with healthcare.
Right.
That can also be a factor. Some of the benefits, consequences of some of these decisions.
Hmm.
There's a lot of things to look at and put together as you think about some of these issues. Certainly reach out to get counsel. A firm like ours can be a resource to you in thinking through your financial planning and portfolio dynamics. We can help you evaluate how's this fit into the whole. What is going to help best enable you to achieve your goals,
Yep.
whatever those are. Whether it's those legacy considerations, whether it's about your own financial security, and so on. Right.
And please make sure that person that you're seeking counsel from is a fiduciary and not a product salesperson. Because if you go to a certain sector of financial planning and they sell
Product.
a product, for example, the solution to your question will likely be that product.
If you sell hammers, everything looks like a nail, right?
Mm. There are many good uses for that product that I'm referencing but not naming, but an annuity. But
the initials are annuity.
yes, there are many times that we will suggest that to a client. It's
I was
appropriate.
going to say life insurance too is the same.
Life
In
insurance.
this pension kind of scenario, sometimes a life insurance product, as we referenced, could be a good
Yeah,
solution,
I said
but not
permanent life
always.
insurance, but I don't say it much. But
Right.
right, so get advice from a fiduciary, somebody who is legally, ethically responsible to act in your best interest, and who will give you advice not related to a specific product that they make a commission on buying. That's all.
Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.